So right now, Perth has the tightest rental conditions anywhere in the country. SQM Research has vacancy rates at just 1.3% citywide. So basically that means that there's just no stock anywhere. And when supply is that squeezed, it's easy for investors to assume that you can achieve growth regardless of where you invest in Perth. But here's the truth. Not all suburbs perform the same way. Some are overly exposed to renters, whilst others are oversupplied, and some already have growth baked into their asking prices. So what I've done for you in this video is I've pulled together all of the key relevant data that drives capital growth. Things like stock on market, renter ratios, vacancy rates, days on market, and then I've overlaid that with what actually makes a suburb attractive to owner occupiers. Things like amenity, schools, transport. And then from all of that, I've narrowed it all down to my top 5 suburbs for Perth in 2026. And here's the kicker. One of those suburbs has huge upside that most investors are simply overlooking, while another that everyone seems to be rushing into, well, it could actually end up being a trap. So you're gonna wanna stick right until the very end, because by the end of this video, not only are you gonna know where the real opportunities are, but also the risks that could sting buyers if they pick the wrong pockets. Guys, my name's Josh. I'm from DataEdge Property, and I help everyday Australians grow their wealth in the Australian property market using data. Data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you smash that like button. With that said, let's jump into the first suburb, and that is Morley. So Morley has been a quiet achiever in the last few years, but its fundamentals are quite strong. It's only 9 kilometers from the CBD. It's anchored by the Galleria shopping centre, well serviced by schools, and with major transport links, in particular with new stations along Naranda. It's a great suburb with strong connections into the city, and for families, that's convenience plus affordability. For investors, you're getting upsides from the yield. So you got a super strong yield at 4.6%. It's still relatively affordable in terms of its entry point. We're only talking about an $870,000 median price at this current point in the market. Stock on market is very tight at just 1.5%. The vacancy rate is unbelievably low at 0.3%, and the renter ratio is under 30%. Now, the last thing that I wanted to point out with Morley is that the long-term growth rate is just 3.9% per annum in the last 10 years. Now, when you compare that to the national average of 6 to 6.5% per annum, you can tell that Morley likely has room left to run. And on top of that, the days on market are just 11 days. So the average property in Morley is selling in just 11 days, which is crazy. Now, it's not all roses in Morley. There are things to be wary of if you're looking to invest in this area. Firstly, there's a lot of older stock. There's houses that were built in the 60s and the 70s where you got to be really careful in terms of the type of property you're buying, but also the condition that it's in. The last thing you want to be doing is entering into a property and realizing that you've got significant maintenance costs heading into it. Secondly, there's a bunch of busy roads going through Morley. And for various reasons, I tend to avoid main roads, but that's another thing that you should be wary of. These old 60s, 70s homes on main roads can genuinely be money pits. And whilst the overall suburb might look fundamentally strong based on the data, average stock is not going to deliver you the growth that you may be seeking. Now, if you think that Morley looks good, wait until you see suburb number 2. It's got virtually no stock on market, which is the kind of scarcity that forces buyers into bidding wars. The second suburb, of course, is Alexander Heights. So Alexander Heights has a median value right now of $801,000 based on the most recent Cotality data. Now, one of the key strengths of Alexander Heights is its yield. You've got a starting yield of 5.2%, which, you know, just a few years ago, that was pretty common in Perth, but given how high prices have gone, That's actually pretty rare nowadays. So if you're a yield-focused investor, Alexander Heights is definitely one to look out for. Thirdly, the vacancy rate is just 0.4%. So what that means effectively is that if you've just bought an investment property in Alexander Heights and you're looking to list that property up on the rental market, well, that rental property is probably gone before I even have a chance to finish recording this video. Now, what about the days on market? Well, we're sitting at just 12 days based on the most recent REWA data, which is, again, incredibly quick, similar to Morley. Now, one of the advantages of Alexander Heights relative to Morley is that it's got a lower proportion of renters, meaning that in theory, and this probably ties into why the vacancy rate is lower, relatively speaking, it should be easier to rent a property given that you're competing with less investors in the market. Stock on market sits at just 0.77%. So there's pretty much no stock at all, which is twofold. A, it means it's incredibly difficult to buy something in that market because as soon as something goes up, well, it's likely already been scrapped up by a buyer. But secondly, that tells us that there is immense price pressure on the ground. Lastly, the 10-year growth rate for Alexander Heights sits at 4.5%, which, similar to Morley, is under the national long run average of 6 to 6.5%. So Alexander Heights, it's not all about scarcity. Lifestyle-wise, it's a family-friendly area. It's got good schools, shopping, parks, and it's still within 20 kilometers of the central business district with freeways and rail access nearby. Investors love the combination of affordability and family demand. But at the same time, there are things that you need to be wary of. Similar to Morley, it's got older housing stock from the 1980s, so you've got to be careful in terms of your building and pest inspections and doing the correct due diligence prior to getting in. Some properties are definitely going to need major updates heading in, which is fine if you're aware of that, but otherwise you're going to want to stick to well-presented properties that you're not going to have to overcapitalize on after you invest into them. And by the way, if you want to understand why Perth as a whole is set for growth, not just these 5 suburbs, you're going to want to check out my Perth market summary analysis, including my overall market forecast for 2026. I've got a separate video where I dived into the migration data, the infrastructure spend, and why Perth could continue to lead the country well into 2026. I'll link it up here. It's also in the description box down below. It's definitely worth a watch if you want to see the bigger picture. All right, well, that was scarcity, but what about a suburb that many overlook? Well, suburb number 3 is one of those hidden suburbs, and that's exactly why it could surprise a lot of investors. So the third suburb is Ferndale. It's a sleeper suburb. It's along the Canning River, full of green space, and attracts first home buyers and families chasing lifestyle at affordable prices. For investors, it's an accessible entry point with values still under $850,000. The yield is probably the weak point on this one. It's at 3.6%. Definitely the lowest out of all of the other suburbs that we're going to speak about in this video. But at the same time, the rental market is still super tight in this area. You've got a vacancy rate of just 0.6%, and stock on market is under 1%, sitting at 0.83. So although your yields are lower, you've still got those extra tight conditions on the ground, which is going to feed into that price pressure and ultimately likely higher asking prices throughout 2026. Some of the things that I love about Ferndale, again, is the renter proportion. It's only at 22%. So what that tells me, again, is that you're not going to have that level of competition that you likely will in places like Morley. There's high owner-occupier appeal, which is also going to put upwards pressure on capital growth in the short and medium term. And lastly, the 10-year growth rate also sits at 4.5%, which, similar to Morley and Alexander Heights, again shows that it's got runway still left to go in terms of future capital growth. Now, what are the risks of a place like Ferndale? Well, I'd be wary of buying properties with little land content or compromised patterns. So you don't want to be buying a battle axe wound site. You want to be buying nice, rectangular, large sites that have future potential should you ever want to develop. subdivide, renovate, etc. While there's absolutely demand on the ground, the wrong dwelling in Ferndale could absolutely underperform the broader market. So Ferndale is definitely one that I would be looking out for across 2026. And if Ferndale is the hidden suburb, well, suburb number 4 is the lifestyle one. Close to the coast, universities and schools, and still showing very strong demand on the ground. So let's get into it. Number 4 is Edgewater. So Edgewater sits in the city of Joondalup with Edith Cowan University, top schools, shopping hubs, and minutes from the beach. For families, this is absolute lifestyle gold. For investors, it means demand is locked in from both renters and buyers. With only 17% renter proportion, you're looking at a market that has pretty much exclusively owner-occupiers, but just enough renters to make it attractive to those who still want to rent. At the same time, you're getting yields here which are slightly stronger than Ferndale at 3.9%, but not necessarily as strong as areas like Alexander Heights and Morley. So if cash flow is tight, then that's something that you should absolutely be conscious of when you're investing into Edgewater. In terms of the other important metrics, vacancy rates, absolutely not something you should be worrying about, 0.5%. So again, rentals are gonna go like hotcakes, and same as days on market, which is just at 7 days, looking at the most recent data coming out of REWA. Lastly, stock on market, extremely tight at just 0.5%. And the 10-year growth rate, we're just looking at 4.4%, which really tells us the exact same theme as the other suburbs that we've spoken about that are all at that level. And again, the idea is there's still further runway to go relative to the very long-term growth rate of Australia nationally. But it's not all upside. There are still things you got to be cognizant of. And what do you need to be wary of with Edgewater? Well, the first thing is overpaying. At a median price of 969K, you need to be very selective. The last thing you want to be doing is overpaying well above what a property is worth. And that's especially the case with properties on busy streets or with poor layouts that aren't necessarily going to see the same growth as other properties that have much better layouts and that are on quiet, well-located streets. So that's something definitely to keep in mind, but Edgewater is a suburb that I'm going to be looking closely at in 2026. Now, just a quick reminder, if you're looking seriously at Perth Suburbs today, don't skip your due diligence. Guys, I've put together a completely free asset due diligence checklist with the exact steps that I use to assess suburbs and properties. Grab it in the link in the description down below. It's completely free and it might just save you from buying the wrong type of asset. And with that said, the final suburb on this list might just be the most interesting. It's affordable, it's close to the CBD, and it offers green space appeal that families love. But there's one risk here that you might want to know before you buy. Suburb number 5 is Linwood. So Linwood has a median price of 750K. It's only 13 kilometers from the CBD and it's alongside the Canning River Regional Park. For those that aren't familiar with Perth, Linwood is just underneath Fernwood. They're right next to each other, and it's got schools, it's got shopping, it's got strong green space appeal, which families absolutely love. For investors, it also ticks a lot of boxes. It's got affordability. 750K of the 5 suburbs that I've spoken about today, it's definitely the most affordable out of all of them. And at the same time, the yield is still relatively healthy. We're looking at a gross rental yield of 4.6%. And whilst that's not as strong as Alexander Heights, it's still strong in its own right, especially given the current median price. Renter proportion, a little bit higher at 28%, but again, one that's under 30%, I don't tend to get too concerned, but again, it's on a sliding scale, right? There's other suburbs that will have a lower proportion of renters. Days on market, super hot at 12, and stock on market's actually a little bit elevated at 1.82%. So that's something that I definitely want to track over time to get an understanding of whether that's something that's going to continue to increase or whether it might reduce from here. Lastly, and this is probably one of the most attractive parts of the data set for this particular suburb, the long-term growth rate of 3.9%. That's well under the national average of 6 to 6.5%. So of all the 5 suburbs that I've listed out so far, it appears that Linwood has a longer runway compared to the rest of them, and that's something that I particularly like about it. Now, what are the things to be wary of? So Linwood, you got to be careful with its flood-prone areas, pockets near the river, and micro locations that have weaker rental demand. And to be honest, the flood-prone areas is something that you should also be careful with Ferndale as well. You're going to want to stick with elevated, family-friendly streets with high land content to avoid these traps. So that's Linwood. Definitely a suburb that I'm going to be keeping a close eye on heading into 2026. So there you have it, my top 5 suburbs for 2026. They all share the same DNA, tight stock, family demand, and yields that all stack up, but each comes with its own risks that you need to be prepared to manage. Now, if you found this breakdown useful, I'd love if you gave this video a like and subscribed. It genuinely helps me keep creating these data-driven updates for you. And honestly, thanks for sticking around until the very end of the video. I don't take your time for granted, and I hope this gives you more confidence in how you approach your own property investing decisions. With that said, I'll see you in the next one.